Where do you think the most affordable market is for real estate, specifically single-family homes in the United States? You're going to have to watch the rest of the Gray Report to figure out which market that is, because on today's episode, we're going to be getting into housing affordability, capital markets in the multifamily industry, as well as talking about distress. Where is it? Is it bubbling up? Is it actually going to happen? Or is it just some boogeyman that everyone keeps talking about and allows Matt and I to keep just talking about distress every single week? Well, we've got the data here to talk about it, actually put our fingers on the numbers and the data. You're not going to want to miss this entire episode. Let's just get right into it. All right, welcome back to the Gray Report. Joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, you got me really excited. You just were throwing out some statistics before we got started. I know I'm getting ahead of myself, but you threw out some, insane metrics in terms of absorption. And it just reminds me that things are changing very quickly. You cannot be complacent in this type of market determining, which direction things are rolling. I mean, again, we were living in a high tariff world, or extremely high tariff world a couple weeks ago. Now, it looks like the underlying fundamentals of the economy might be more soundly footed.
Yep.
We're talking about distress in the multifamily market, really bring down prices, but then we see some really bright spots in terms of fundamentals, just demand. I ask you this all the time, Matt, but again, you're just getting off going through dozens of articles that have just come out this last week, new data, so it's all been kind of synthesized up there. What's standing out? Really, you don't even, not even specifically anything in these articles per se, but what keeps rattling around up there?
I don't think that we're completely done with economic uncertainty, but I was really surprised at the strength of the multifamily market and the strength of housing demand in general.
Yeah.
And it does seem like there are some real benefits to having an affordable market. And that's probably where I'd place my confidence, is in these more affordable, maybe a little bit lower supply, but also if you have that affordability, then there's a lot more legs than if you have like kind of expensive market that has had high supply. There's reasons for people to maybe get a cheaper apartment.
Affordability is an interesting conversation because depending on who you're speaking to about housing affordability, that conversation goes very different. And I guess the perspectives that different individuals have, depending on their relationship to housing, is very different. You go on Reddit, Matt, I think what everyone's opinion is on housing affordability. It's never been more unaffordable. It's insanely how expensive housing is, whether that's rentals or single family homes. Then you talk to a bunch of, whether it's real estate investors or housing economists that may paint a little bit of a different story. Some of that is just the lack of information, not tracking the data. Some of it is lagging information of everyone remembering rent growth back in 2021 and 2022, and also remembering where rents were not that long ago, back in 2019 or 2020, and getting sticker shock when you're going to lease a new apartment or go buy a home. You're seeing that mortgage, your interest rate and your mortgage payment is a multiple of what you were considering just several years ago. So I think it's that sticker shock and the slap back, but there are some bright spots. The National Association of Realtors has a new report out on housing affordability and supply, and they identified some markets that are more affordable than others. But really trying to parse through some of the good news, bad news, and it seems like we're still in the midst, and we're still kind of stuck in the mud relative to affordability, supply.
It doesn't seem like we've made any progress.
I mean, again, they've been saying 4 million housing units short, but I don't think we've dug out of that hole at all. So curious your thoughts on this NRA. Get us up to speed.
As you were talking about, Reddit, and I think that rental affordability has improved. Rents have stagnated, or at least been below inflation for the past couple of years, let's say, and home buying prices, for sale homes have not had that. Home affordability of single family homes is still crazy high. It's a lot higher. It's a lot lower. Low affordability, high unaffordability. Single family homes are very expensive. And rentals have not gotten as expensive. They were still, maybe if you're still factoring in the last 5 years as a whole, maybe rentals, yeah, they did go up, but the trajectory stalled out like 2 years ago, and rent growth sank down. And we were talking about that a lot, and it was because people built more. They built a lot of single family homes, but the prices still went up.
Yeah, so why haven't we seen that effect? Because there's been a lot of new supply of single family homes, but also the cost to own those homes, whether it's your mortgage payment, but also the your capital expenditures and just the materials if you have to fix something up or to renovate a home, all of that's more expensive.
Yeah.
But there are still buyers that are keeping the prices where they are, and they're not growing leaps and bounds, but they're still in positive growth territory.
Yeah.
Which is shocking. Why
It's like
why
the
is that?
marketplace prices haven't changed, but the mortgages have gone up.
Yeah.
So no one, and I think there is a significant amount of homeowners that are sitting on lower interest rates than they would before. I'm not sure if it's in this NAR report, but in the Newmark report that we'll get to. There is a difference between the average mortgage rate held by everyone and then the new mortgage rate, and that's just way high. And like the same thing, right when that gap started appearing, well, yeah, you also saw a big downshift in the amount of homes that were sold. People are buying and selling less homes, and it looks like maybe the ones that are bought and sold, they're still keeping that price because there's less price discovery. I think mortgages are making it more expensive, and I do think, and I said this for the past 6 months or so, I think that there is room for softness in the for sale home market. You could count me out. I've been wrong. I haven't. It has not emerged at all. But like, I just see in the future, and like something's got to give, right? And maybe I'm letting the rhetoric get to me, but if you look at this gap between the rental affordability and the single family ownership unaffordability, it's just a huge flashing light. And also considering that like rent growth has reacted to this huge jump. So why hasn't the market for single family homes reacted to that huge jump? It just keeps going. And so that's the big mystery here is, the headline that I wrote for this past Sunday's Gray report was, we built a lot of houses, affordability hasn't budged. And it's just sad. It's like, I'm a little bit flummoxed, and I think it is a lot because we are approaching maybe a tipping point in the for sale home market. Someone else could explain it differently, but it does seem like we're on the verge of something.
Well, I think you might be correct. I mean, while we haven't seen really any price declines, inventory is now sitting out in the market much longer than it was a year ago. And so that's either telling us that the supply really has started exceeding that level of demand, or the demand has really come down.
Yeah.
But the other piece, my intuition and from conversations we've been having and all the research we've been reading is that it feels like we've built a lot of houses, and we have built a lot compared to maybe our pace of building post Great Financial Crisis, but we still haven't built enough. It doesn't seem like we've been able to dig ourselves out of the hole, whether it's 4 million housing units short, but we needed to build more than we really kind of needed at one time to try to kind of catch up.
Yeah.
And I guess the only thing that makes sense is we're still so far behind, and then there are enough individuals that have the ability to actually buy what's on the market. And I think that's the surprising thing is that it's not just in the higher end of the spectrum, but those middle income buyers are also, buying those homes.
Yeah.
And maybe it's folks that are maybe moving down in quality, but I don't see really that happening. The other factor is certainly home builders are offering incentives and buying down rates for home buyers because otherwise they just wouldn't be able to afford those payments.
As part of just like kind of checking my work and corroborating some of the findings from this and other sources here, I looked at the new home sales as measured by the census or on like the Fred website, and new home sales dropped, but they didn't drop down to like below pre-pandemic levels. Yeah. So there are people still buying new homes, and it just dropped, but it still did drop from a peak. So that to me suggests that we're not maybe building as many if they're not buying the new ones, or so there's a little bit more that I don't know in the single family home market than the for sale or than the rental market. But I still think that this story of affordability is particularly interesting, and it makes me think that, affordability, it's nice for the home buyer, it's nice for the renter, but it's also nice if from an investment perspective, if you have a asset you're in a market that's considered affordable, you have a little bit more cushion. And renting as like a form of housing is more affordable than homeowning. Maybe the rental market also has a little bit of cushion. It certainly does look like that if you see that gap between the price. But I think it's a little bit more complicated. And the most pessimistic view is to see that would be that as single family home prices drop, so do rent prices. But I can't help but see that gap as a little bit.
Well,
of a cushion
we've looked at the chart, and I don't know if we have one ready for today or not, but we'll pull that up.
Yeah.
Looking at the difference in the gap between renting and owning. Right there. So that this gap. There was obviously the spread always. It changes here and there, and the spread really widened. Prior to the Great Financial Crisis, it got tight, but since COVID, the spread between renting and buying has just completely gone off the rails, where on average, according to Newmark, the average rental is about $1,827, but your mortgage payment on average is around $3,000, so almost double, where prior, that spread was much, much tighter. And so we've said for a long time, something at some point is going to have to give to bring the spread more in line. And it either has to be two things. It either has to be single family, mortgage payments becoming cheaper, or rents being higher. And
I wonder if there is a little bit of insulation here, because rents did not increase at the same level as single family home prices increased. Or single family home costs. So maybe if those costs do fall, maybe we'll get a little bit better. And I also think these costs do seem to coincide a little bit with rising interest rates, but it didn't double the price. That's a lot of that is marketplace price increases that happened in that time.
It didn't double the price of the home necessarily, but the cost to own the home, or that mortgage payment. Certainly almost doubled from where it was.
Okay.
Just going back to affordability, one question that I have for you, Matt, is when we think about affordability, just on the surface level, we're talking about again how the ability of someone to be able to afford to buy that home, but looking at it also as maybe a leading indicator in terms of future employment growth, job growth, and population growth. Where the idea is that in an affordable metro, where someone might have a higher probability of being able to actually purchase a home, does that make that market more attractive? Does that spur more in-migration? And I ask that, or I bring that up because we're hearing that a lot as migration drivers.
It hasn't always been the same.
It
hasn't always been that way. I think a lot of times in the past, there was an attraction to the higher costs. That's where the jobs are. Yeah. You go to where the jobs are, and then the rent goes up, the price, the cost of living goes up, but still people move there because your job's paying you more.
Yeah, exactly.
It's like when you move to New York, you're paying half of your wages in rent, but you're still making a lot more than you would in, let's say, Columbus. I think there is a difference, and you can see it in the jobs that are coming into the places in the Midwest, and maybe businesses are recognizing, well, it's actually cheaper to relocate here or to locate here. I think that's really interesting. And we're seeing a little bit, the migration in the Midwest specifically, it's fairly healthy. It's not like people are moving out of there. So I think that consistency, if maintaining that and maintaining the level of stable job growth that you have, makes Midwest pretty attractive for someone to relocate to. I don't know if it's exactly a job center, but we are looking at, part of what this most recent report, if you go to greatcapitalllc.com, you'll get it right there. We tracked all these economic developments, all the businesses that are moving in, all the businesses that are still headquartered in Midwest and aren't moving out. So there are people living, breathing, thriving in there, and I think that it is a cushion. It is a little bit of an insulation between and room for maybe growth and appreciation in some of the housing market. In the more affordable markets, there's room for things to go up. Whereas in so many markets, they're probably going to go down a little bit before they go up.
Yeah, and I guess that's the other good part of like the spectrum to be aware of. Sometimes you get what you pay for, and things are cheap for a reason. It's because there's no growth. But in the cases of some of the markets that we're talking about on the list, they're relatively affordable, but there's also a decent amount of growth that's going on.
That was just really interesting. Like affordability itself, instead of being a sign of low growth, it could be an attractor for more growth. That's the kind of controversial proposition that I want to make, and I think it's got some legs, and we'll have to see how that works.
I mean, if you're in, let's call it, whether it's New York City, which is seeing a lot of rent growth right now, or any of the coasts, or even some of these Sunbelt metros that have seen, really substantial rent increases at least a couple of years ago. They've moderated since, but they're still more expensive. Let's say you own a home in one of those metros, or you're looking to buy a home, and you can't buy a home in those metros. Just that the single family homes are so expensive, they're not affordable. But if you do want to live that American dream, you do want to buy something, and you just decide it's just not an option in where I'm currently living in Nashville or Austin, at some point you start looking at, where can I buy a home? And with remote work, I think that there's probably some more optionality. I was going to ask you about that a second ago, but my gut is that it plays a role, but not an outsized role.
Yeah, I agree.
But
I think it's the same thing as when we kind of worked through this early in the pandemic when remote work was rising. I think it will make you move to maybe like a suburb of your city, but not to another city. At least that's my thought.
Do you think, though, I guess it just it invites the conversation of I don't have to work in New York City or Los Angeles, these major hubs.
Into it.
It's like, let's think about our whole lifestyle, and there's opportunities everywhere. And maybe I can't get a remote job, but at least let's look at what's available in that city. And also there are remote opportunities that are out there.
In a environment, and we'll see this too in the new market report, where people are actually anticipating more inflation. They're anticipating more rent increases, but I think I'll talk about that in a second. In a situation where affordability is coming at a premium, so to speak, I think that the affordable markets are that much more of an attractor for people. So this will be super interesting to see if they relocate or what kind of population and job growth comes as a result of being an affordable city.
Let's look at this report from National Association of Realtors, because they are ranking some of the most balanced in terms of affordability. First, Matt, can you help me understand, I guess, exactly what they're referring to in terms of getting closer to balance? I know it's becoming more affordable, but what is this balance?
What they say here is the area is getting closer to a balanced housing market. 30% of the 100 largest metro areas are the quiet achievers because of the availability of affordable listings is better than in other areas. I think that this is a balanced market score, and one is the perfect balance, and all these markets are very close to it. I don't think that it's actually I think it's a mixture of different variabilities, but it also reflects which income levels, how balanced is housing affordability across different income levels. Things are not all of the same in different regions, especially different markets. And you can see, I think that, there's a fair amount of Midwestern markets here and the ones that are getting closer to balance.
Yeah, so this is interesting. So one is a balanced market, perfectly balanced as they defined, and taking the top spot. That's actually a tie between Birmingham, Alabama, and Indianapolis, Indiana, as the most balanced in terms of affordability. And they also, increase in balanced affordability over the last year comparing 2024 to 2025. They have both of those markets marked as a 0.91 on their scale that goes up to 1. Other markets that are on that list of balanced affordability are, Raleigh, North Carolina, Des Moines, Iowa, Grand Rapids, Michigan, Columbia, South Carolina. We mentioned Birmingham and Indianapolis, then Columbus, Ohio, and Oklahoma City. Again, all of those markets I think have a decent amount in common, but none of them are, slow growth markets by any means. Those are all really pretty, I would say, not even from an affordability standpoint, but generally kind of balanced low volatility markets.
Now, there's four of the 10 listed here, or four of, I don't know how many there that are listed as Midwestern, but the rest of these lists, it's regionally diverse. But when you look at the map and the stylized map they have at the bottom, you can see a little bit more of a story of where this affordability is more of a problem and where it's a little bit easier.
Yeah, and let's just skip to that map. I mean, you can imagine some of the most unaffordable metros. Miami, Los Angeles, New York, some metros in Florida. But this goes back comparing 2019 affordability, 2024, and then as well as 2025. So maybe we want to start with 2019.
Yeah, just to describe things, the darker color. So these are a stylized map, and the darker color indicates a greater affordability. The map for 2019, very dark. That's nice. 2024 and 2025, they're about the same level of darkness and lightness. It even looks like in 2025 there's a little bit more light areas than compared to 2024, but both of them significantly less affordable in 2025 and 2024 than it was in 2019. Just to reference some earlier numbers they had in this report, it's about 20% of the homes that people were able to afford in 2019. About 20% of them, they can't afford it now, and they couldn't afford it in 2024. So things just took a big hit, and that yearly difference between 2024 and 2025, like, it's not 20%, it was like 0.2%. So we're just building a lot. It's just taken us so long, and it's so tough to improve that affordability.
Yeah. Well, so I mean, it makes sense, I guess, the anecdotes that, some, renters and, consumers of housing, which is everybody would say that, things seem to be cheaper. Well, they were certainly more balanced and affordable pre-COVID, pre-pandemic versus today.
Yeah. And also, so now that's over time, but then also regionally, you see the Northeast is a little bit less affordable. The West is a little bit less affordable, and the South is a little bit less affordable. And the affordability is really centered around kind of the Midwest.
Yeah, it's a last bastion of affordability is what it looks like. I mean, there was a lot more blue kind of in the middle of the country down throughout the Sun Belt, and that's no longer the case. Much lighter shades of blue.
Yeah.
That blue's going away.
And I will say, time was that you could interpret affordability with maybe an idea of affordability was maybe the sign of a shrinking market, and still could be the sign of a market slowing down. But I think that it's a lot different now, and there are affordable markets that we've found that are in fact actually growing as well. So that's a good thing, I think, on the whole.
Matt, not to throw you off too much, but you want to jump just straight into the Newmark report?
Let's do that.
A lot.
I like that.
We talked about, again, renting remains significantly more cost effective than ownership. But what are some? I always enjoy these Newmark reports. They start with making some market observations, kind of giving us an overview of what they're seeing. And what are some interesting takeaways, Matt, on this report?
Super huge absorption numbers. That's the ones that I was talking about, and really the visual they provide is equally compelling. But a little bit more subdued in terms of sales, still challenges in the debt market, and they also shine a light on distress. They've got I think $762 billion that they've highlighted for multifamily distress. So there's a lot in this report. It covers everything from housing fundamentals to apartment fundamentals to debt markets and then investment sales. So we won't be able to get to all of them, but I still want to talk about some of the more really compelling parts. Skipping to this page 9 here, household growth is growing really strong. It's been remarkably consistent, I think, in the past 5 years. It's just I think that since 2017, it looks like, according to this graph, household formation has been just really elevated, especially compared to the early moments right after the great financial crisis.
It'll be interesting once the data comes in from 2025, even Q1, Q2, really Q2, just with some of the sentiment drop off and whether that suppressed some household formation, just folks not moving out. The conversation that Carl Whitaker and I were having in our interview.
That will be, and especially because in some of these years, like from 2014 to 2015, household formation changed significantly, and there are some periods, even from 2018 to 2019, there was a little bit of a drop in household formation. But the past 5 years, it really has been a lot more stable than previous, and stable in like this elevated way. So that's a really good backdrop for a kind of backstop for housing demand in general. And then moving to page 11, which is which I kind of alluded to. I think that it is the Federal Reserve has this data. It's Federal Reserve of Atlanta. Consumers are expecting rents to grow up. But yeah, skipping to like kind of page 11 here, I did want to highlight this because I talked about this. Consumers are expecting rents to go up, and I think that this is interesting because it is also the third year in a row where people are expecting rents to go up. Now they automatically their expectations for rent growth are much higher than actual rent growth is recorded. Look, even like
this is the perception that leads to like my rents have gone up 10% over the last 10 years.
Yeah. Even pre-pandemic, the rent growth was about like 7%. These were expectations of rent growth. But it is interesting what's happened in the past 4 years. So in February 2022, people were expecting like 12% of rent growth. That's a lot. But then it dropped a lot to in 2023. And then from 2023 to 2024 went a little bit up. And then 2024, 2025, it went a little bit up. So I think that I know that this does say that people are expecting rent growth. I don't think that this actually says that people are capable of or even willing to
not
spend.
that they can pay it.
I think this is a reflection of inflation.
That's what I was going to ask you, and I think you're 100% correct. It's just that I think consumers are becoming familiar with inflation. Mm-hmm. No one had to worry or talk about inflation over the last cycle. It just it wasn't a thing. It was I mean literally it's like economists and academics and talk about it. That was it.
Yeah.
Obviously, in previous decades, in the 70s and 80s, it was all the rage to talk about as well. But I think you're right. I think inflation, rising prices is now in the zeitgeist and it's the narrative that people are talking about. And I mean, in this conversation, I don't think this is going to turn around anytime soon because I think the new conversations around tariffs have reignited the same debate.
Yeah.
And almost a certainty that we're going to see higher prices, which you and I know, we've talked about this a million times. That can be the self-fulfilling prophecy because all of a sudden you start buying more, which increases the price because you're trying to lock in the price today, and everyone does that. And again, you fulfill the promise, and so the prices are higher.
Yeah.
And this type of I don't see this trend reversing anytime soon.
Yeah. I think that we talked a little bit last week about like people are probably clearing out their shelves to take like a political picture that's like, here are the empty shelves. I did see rumors of someone that's on the inside of Target that knows that their Heyday brand or something like that. Their USB charging cables are going up from like $9 to $16 or something.
Oh my gosh,
this is like the insiders are giving us gossip, and we'll see. But I think it's right around I mean, Walmart has announced that there may be price increases, so we'll see how things.
It's interesting. The conversation shifted in some political circles of just everyone. We can just do a little bit more with less. Like you don't need like 20 you don't need 20 Barbies or dolls. You'll just be happy with one. It comes off as a little tone deaf, I feel like, because I think that there's a lot more like pressures that are on people than just like the extra stuff. People still put the food on the table and all that.
Yeah. I can't stop thinking about the vibe session, about like how is this different from the vibe session, and how is the government's role, or just how or maybe like the Fed's role is different or similar. It does seem like very similar, but during the vibe session, that was never resolved. So it may just still be like.
I think this is a return of the vibe session.
Yeah.
I mean, I feel like I'm snap back to 2023. I mean, in terms of the uncertainty around inflation, around the market. Whereas 2024, there was I think some false confidence in that things were going to shake out and normalize this year, 2025. I mean, again, the moniker, survive until 25. Well, it's 2025 and things don't seem any clearer.
Yeah.
And there's no true opportunity to, you can survive, but no one's necessarily thriving in this environment.
Yeah.
Maybe if you're a defense contractor, but that's about it. But I mean, wage growth, Matt, I mean, this bleeds into inflation. This is also on the Newmark report. I mean, wage growth has been, pretty decent. I mean, it's been consistent, maybe a little tick down in March, but it's been rising steadily.
And that's why, like, the vibe part of the vibe session kind of does have some purchase. There are very real policies that have been enacted that are going to make it tougher for people. They're going to make it, especially if they're importing or they're buying imported goods from China. That's like a fact. And but like underneath that, there was like things. There was some just real progress that was being made in the economy, and I don't think that that's going to go all the way away. And I can only hope, just as inflation was transitory, that the current economic policy uncertainty is also transitory.
Well, I think some of the data, and you could say the data is lagging, and we need to get some of the April tariff, data in, but really strong recent jobs report.
Yeah.
CPI came in not too elevated, kind of I think the lowest CPI print since 2022.
Yeah.
So when you look at the underlying KPIs of the health of the economy, you'd say, okay, the economy's doing pretty well.
Yeah.
I think that you can easily discount that to say, well, the data related to the tariffs hasn't come into play yet. But then you also could say, well, we haven't fully resolved the tariff discussion, but it's not as an extreme debate as it was 3 weeks ago. And everyone's like, okay, 10% tariffs, fine. That's not 150% or whatever.
Yeah.
Let's get on to talk about these trade deals and just feel good about ourselves and get the tax bill passed so we can just move on.
I was listening to some economist this morning talking about how the markets seem to have priced this in, the stock market seems to have priced in inflation and tariff uncertainty, and they're kind of beyond it now. I still think that once we do see, whether it's Target, Walmart, or whatever, whether there is tangible price increases and the reaction from consumers, that's going to probably have an impact on the stock market. But that's the last thing that I'm kind of waiting for is when this shows up, because I haven't seen it yet. Yeah. I've seen photo opportunities I did Google empty shelves and I saw some nice photography, but I just haven't seen it yet tangibly. And it does seem like, is it tomorrow? Is it a couple weeks from now? So we'll have to see the huge impact. It's not real yet. To me, it's just abstraction.
It's all abstract. And again, if the tree falls in the woods without anybody there to hear it, did it actually make a sound? And while it was scary there for a minute and there's still uncertainty, maybe now there's at least enough certainty for us to, I guess, to adapt. Moving on to this chart also from Newmark related to supply and demand. You mentioned this earlier, but this was kind of the most kind of insane, exciting thing you saw today. And we've mentioned it a little bit, but I think it bears repeating, and I think some of the affordability is at play here, renting versus owning, but just incredible amount of new supply that's been coming on, but that is second to the unreal amount of demand for apartments. It's surprising.
Yeah, the demand. The increase in demand and even just the specific peak, it is almost again like a mirror image of when rent growth was growing like crazy in 2021. That is the same. We're at the same level of demand, and we're also at the same level of demand as relative to existing inventory. So that's I think it speaks to the amount of new supply that did hit the market. But this, I think, in the same way that the economy was set up really well, I think the multifamily market is set up really well. And this is a very dramatic expression of high housing demand.
Yeah, I mean, and just to read from the report, over the past 12 months, demand has outpaced supply by 131,000 units. Even in the face of record high deliveries, absorption reached 707,000 units, more than 3.5 times the long-term average. So again, absorption 3.5 2x what it has been historically. Demand as a share of inventory rose to 3.5%, making the third highest level on record. With sustained, durable demand and a projected slowdown in new supply, market fundamentals remain positioned for continued positive momentum. We had Carl Whitaker on the program, and I asked him, how much of this is build it and they will come.
Yeah.
Some of the demand spurred by some of the new supply. And he said that his response, which I highly recommend checking out the interview in the episode that we just posted. But you can create some demand by new supply as it allows for almost a place for that demand to go. And it provides that option and can then spur some household formation.
Yeah.
Hey, there's a new option down the street. We've been buddies living together. I'm going to go check out the new apartments. There certainly can be some of that. But we also could see a scenario where if there truly wasn't as strong of a demand environment when we delivered so much supply, we would see a fall off on every metric, and just demand wouldn't rise to meet supply. But again, as we mentioned, I think that the fact that not as many people even have the option to go buy a home and get a mortgage, and that renting is the only option, has to be leading into this as well. But really exciting, and interesting to see.
And another figure they have, if you just isolate the first quarter, the multifamily is the strongest first quarter since 2000. Q1 is not typically the strongest single quarter for absorption, but the fact that this is breaking that record that happened in 2000 is really
so theoretically. Now again, we had a slightly slow April, but if we follow the tracks of seasonality as we see quarter by quarter, and this is looking every other quarter, looks like one Q1 to Q3, but Q2 sees most of the growth, and so we should even see a higher level of demand followed in Q3.
It's going to be really, really interesting to see. Again, like, we haven't seen the reality yet. Maybe people will be full of that uncertainty and they won't be moving into new apartments. But if this trend is any indication, they probably won't drop off that much. Yeah.
And then just to your comment, Matt, on this chart, multifamily posts strongest first quarter absorption since 2000, just like that chart. Certainly. Again, if someone asked me over the weekend, Matt, I was at a kid's birthday party, and asked him what he did. He was asking what I do, and I told him I'm in the apartment space and we buy apartments. And he said, "Is that really, does that make a whole lot of sense to do right now? Is that do the fundamentals kind of make sense?" And I don't think people, this chart paints a very different picture from the perspective that question was asked.
Yeah.
This is an incredible relative to history. Looking at the long-term average of 18,000 units that would be absorbed in a given quarter, and we had 138,000 units that were absorbed. Now, we have been punching above the average for quite some years. In fact, every year, most years have been above the average.
Yeah.
There's really, you have to go back, really back into the early 2000s to where we had negative absorption for quite some time. And so I would be more curious on the average over the last 10 years maybe rather than the last 20 years, because that would certainly paint a different picture, because we're kind of just this 18,000 is, but even then, this is the most absorption we have seen by quite a lot since 2000, regardless of the average.
And then they have here the demand relative to supply is strongest in the lower supply markets. That's a little bit of an obvious statement, but I think it also maybe implies that in some of these oversupplied markets that there was a bet that the growth in the household formation would exceed the growth in the supply. And the fact is, like, maybe as a rule, supply was way easier to add than demand. And again, we've said this before, said it last week and the week before, like, these hot markets are going to recover, but it's going to take them a lot more time. A lot more time for the market and the demand to react and kind of balance with the new supply. That's more difficult than it is just to build the apartments.
Yeah, very true.
If we want to skip to 22 and 23, there's about regionally, the Midwest is continuing to excel, and the West Coast is it's doing all right, but it's definitely not like in the
Got a
top.
rally. It's continuing a rally.
I don't know what the rally is denoting. I think it's maybe the
Recovery.
The recovery, yeah, the kind of general
Yeah, I
recovery.
think that's a base effect.
Yeah.
Because it's much more of a recovery probably than a rally. But yeah, Matt, tell us what this highlights.
Basically, it's showing the rent growth in places like Chicago, Kansas City, Detroit. They're doing excellent in Indianapolis, Minneapolis. In the leaders in year-over-year rent growth are all, basically all in the Midwest. And I would argue like it does seem like they have a pretty strong recent growth too. So it's not like they're going to fall off all of a sudden as well. And then again, like that, this is the fundamentals here. Talk about rent growth and occupancy by region, and they have Northeast, and this is something that we've seen in RealPage data as well. Northeast is a little bit better for occupancy, but Midwest is a little bit better for rent growth, and that may change, here and there, but again, like it's pretty hard to argue that these lower supplied regions, the regions that weren't really like the hot spots in the Sun Belt, those are the ones that are doing well. This is not a unfamiliar thesis for anyone. It's just worth noting here, and it would be negligent for Newmark to exclude that from the report. Do you want to skip to loan maturities? So all right, let me look here. Page 36. They and again, there's like lots of stuff in here, and I've cried a little inside when we skipped over some stuff about the supply fall off. But like, I will warn people, there will be a supply fall off, and the construction activity has been reduced. But you can read that rest of that in the report. I want to focus right here on this $769 billion in multifamily loans that will mature from 2025 to 2027.
That's even a larger number than I think we reported.
Yeah,
last
we kind of
week
try to guesstimate it. Yeah, and
Yeah.
this is way big. And it is also well worth noting.
Almost $1 trillion. I mean, it's $750 billion.
Yeah, that extend and pretend is like a real thing. It's and they actually point to it here in the following page. They say, loan extensions are not traditionally a sign of health. They kind of point to it whether in guarded language or a lot more directly actually than I thought. They're like, these people are extending these loans, you better watch out for this. That's the sum total of the discussion from page 36 to 38 of this Newmark report. This maybe plant a seed that like some of these are real. Some of these extensions were short term and they are going to expire, and it's not traditionally a sign of health. I also was looking, earlier in the report, they have stuff about the debt market and non-bank lenders. And there was also points that Marcus and Millichap makes this point about how some banks have options too. Like it was just an interesting thing that I think about it, but like, you read about borrowers saying, okay, I want to go to private credit, or I want to do this. Like, borrowers have some options, or they can do a capital call, but banks also have an option too. Yeah. It doesn't automatically mean, all right, you're in trouble, you got to sell it for really cheap. So that it'll be interesting watching that space. I see it though as, if it does have any relevance to like the sales market, it could mean that they're more willing to swallow a lower price. And maybe there will be some pragmatic owners that they have one troubled property amongst an otherwise really well performing portfolio, and they're like, we've done the math here, we can struggle, we can do a capital call and maybe make some investors a little disappointed, or like we can kind of try and sell it and do the best that we can right now.
Well, no one wants to sell when your value's down.
Yeah, even the investors.
If you don't have to. Yeah. And and if it's not good for the bank, if it's not good for the owner, there's not a lot of like willing sellers right now, unless you really have done well and you're just you just want to sell in this environment for a variety of, I guess, strategic reasons. But until someone, whether it's the lender, the bank, or it's an equity investor that tells whoever controls the project, the deal sponsor, that give me my money back.
Yeah. Very true. Even investors may be like, all right, fine, I'm going to make 90 cents on the dollar, but like, I'd rather have that now than zero later.
Exactly. Because right now there's owners that are saying, or the sponsors are saying, just give us some more time, give us some more time. But you have some LPs and owners that are saying, look, it's been years since you've given me any sort of return. I've had this money just parked over here. I want my money back to put back to work somewhere else. I see opportunities coming, and I don't want to just sit around and wait another 2 or 3 or more years for then you to then maybe give me my money back, or then tell me that it's gone. Or and you're telling me, well, we're going to eke out a little bit of a return. I don't care. I'll take, like you said, my 97 cents on the dollar or my 75 cents on the dollar, or just give me my money back and then go off and find my next deal. There hasn't been enough of that because, that forced selling is kind of, a forced loss. And, is the question of, are you making an unforced error at that point? But, people's patience only can run so long.
What if it was? I'm speculating here. I don't know everything about a fund structure, but if it was bought as part of a fund, would that make it easier, or would that make the impact less dramatic for the investors? If this was wholly bought by a fund that has like maybe 10 properties, you're cutting loose the one that's laggard, and it's okay.
Yeah, I mean, every situation is going to be different, right? But 100%. I mean, we bought a property a couple of years ago from a REIT that had bought the property that we purchased from them. They had bought through a large portfolio. It wasn't it was in a market that they had no other presence in, and they would not have bought the property as a one-off if that was just the property. It came with a portfolio that they bought. This was in the period of where interest rates were rising, and they were trying to kind of figure out what they were going to do, and they ended up selling the property to us and took a $4 million loss. But to them, it was advantageous to do it because that they were able to use those proceeds. They still had proceeds, and they were able to use that to pay off some of their debt. In general, some of their debt obligations, went down, and then they had a whole program where they were selling properties. And obviously, they were hoping to sell them at a profit, but they sold a handful at a loss. That allowed them to remove some debt off their balance sheet, raise some cash, and so their balance sheet looked much more attractive. They were able to get a better credit rating and go out and raise more capital to go buy more properties.
And that is my mental image is of the larger, like a larger organization, maybe that's less connected to kind of the emotional baggage of like losing the deal. That it's more like, listen, we're looking at these from all different angles, and this is going to help us. It may look like a loss, but like long term, it frees up money, and then we're going to go out and buy more apartments that maybe do better.
Well, and there's all kinds of different dynamics at play. I mean, pref equity adds another variable to the equation of where you don't just have the common equity, the sponsor, in the bank. Now you've got another investor type, the preferred equity investor, which that has become much more prevalent in the last couple of years. Many deals were done, using some sort of pref equity, and those have their own sets of terms and objectives. Many of those don't want to be deployed for an extended period of time. They want to be deployed for a couple of years, and then a capital event typically needs to take place, whether it's a refinance or a sale. Now there's pref investors can come in a variety of shapes and sizes, from just normal real estate investors who are just structuring the deal as pref. It can come from the sponsor themselves as structuring their deal to include like a pref-like piece, like a or income units that like a lot of other groups have done. Or it can come from a big institution that is very rigid and has a specific set of guidelines. And if you're supposed to return that money and have been providing a 12% preferred return, there's that often comes with some strings attached, being in that kind of priority position in the capital stack. So it's a different dynamic that could put more pressure on some sales, because again, they don't necessarily need to make a huge return. They just need to get their money back and get their 12%.
I'd be nervous if I was an investor and seeing the pref equity come in front of me, but if it was a good operator, that's great if there's a plan for it, but it'd be a little bit of a bummer.
I think it's different if the deal is set up with pref equity
Okay.
from the onset, and you go into it being like, yeah, there's pref equity
yeah.
in there that will allow us to get a high rate of return. But typically, pref equity only really helps a deal if you can take the pref equity out relatively early, because the idea is they get paid their 12-14% over the period, and then you can pay them back
Okay.
usually through like a refinance, and then you can maintain the ownership of the property. They go away, you don't have to pay that 12% hurdle anymore, and you keep on going. But if you can't hit that hurdle, all of a sudden, they can, in many cases, take over the property, kick out the sponsor, and have some rights. Now, that's the difference between kind of hard pref and soft pref, which is a conversation for a later
it does
day.
seem like a little bit of a complicated wild west of the non-bank lending space, and I'm still kind of trying to wrap my head around pref equity and private credit and the difference between all these all these loans. And
I mean, it's an opportunity for a higher rate of return is the idea.
Yeah.
And sometimes it's because you want that rate of return. Sometimes it's because you don't have the equity that you can raise.
Yeah.
So you need to use it. But there's just almost always more risk involved because, again, you're increasing your leverage. It's called equity. It's called pref equity. But it's really just it's mezzanine debt, under a different name. So, if you increase your leverage, you're increasing oftentimes your return, you're increasing your risk.
Okay. This on page 37 of the Newmark report does show how near-term maturities have been increased by short-term extensions. This $97 billion of extensions were in
these are mostly all extensions this year.
Yeah.
It's former bridge loans, or I guess other forms of debt that were extended. They were going to expire at the end of 2023, which was we started covering the loan maturities reports, and there's this huge wave, and then everyone's like, well, what happened? Other than cap rates decompress, but they were all extended. Now they're expiring in 2025, 2026, and a little bit in 27.
Then there's another graph on the following page here. Oh, no, it's not. Oh, 39, that's what it is. This is really interesting here, I think, because it says distress has been suppressed by widespread use of loan extensions. And this was our argument. They're repeating it here. Everyone said we were crying wolf. Maybe we were. And we'll see some data from CredIQ and TREP that maybe suggests a little bit more complicated, but it certainly does look like delinquencies are heading up in general, and they just pointed to those loan extensions. I don't know if I'm making this perfect narrative a little bit too clean and tidy, but it's like they extended once, maybe they extended twice, and maybe third strikes you're out.
See, that's where you can keep extending, and as long as everyone's like, yeah, that's fine, let's keep it rolling. But at some point, there's going to be people that will say, individuals that are investors, and I think part of it is happening of give me my money back. Give me my money back. I've given you money a long time ago. I've given you an extension, given you another extension. I want the money back. I mean, we saw, like the Tides Equities portfolio, lenders are going after them on their personal guarantees. I think that is a symptom of kind of where we are of that. Again, it's like, guys, these are supposed to be bridge loans. They're supposed to be short-term in nature. These aren't permanent loans. And we're sorry things didn't work out, but that's business. That's the risk you take. You're trying to make a bunch of money by taking on a lot of debt, and it didn't work out.
Yeah, no, and even John Chang, and if we want to skip to, because I think this is a pretty good segue to this trio of graphs really that I have on the loan delinquencies and potential for distress. John Chang, I like this quote here. It does say, he says, lenders are becoming more stringent in policing the loans that aren't in compliance, requiring the borrower to refinance their property or sell it, or in some cases, the banks are selling the note to another lender, or even initiating the foreclosure process. And there was a graph there up that was showing very similar, just this increase in delinquencies that he's seeing as well. I just like that it's not just in delinquencies that are increasing. There is the suggestion that banks are getting stricter, that aren't giving people a free pass. I'd love to see if someone can quantify that. If someone could say like the percentage of people that come up to ask for extensions getting
requests.
denied.
I'd be really curious about that.
But that does seem like, at least in the air, in the discussion, there is an increasing idea that, all right, things are getting stricter. We saw the guidance from the Fed that was like, extend and pretend, let's put it to an end.
Yeah, exactly.
People still are doing it. It seems like some extensions are still happening, but it's not. But like, this is it's a completely different environment than it was in 2023.
And as we mentioned before, it's very sponsor dependent, relationship dependent.
Mm-hmm.
What does this credit IQ graph
So
show us,
okay,
Matt?
we saw increasing delinquencies from the Newmark and also from the Marcus Millichap that looked like a clear line upward. This is an important outlier, or at least an important like complication of the general narrative that suggests that that delinquencies and like kind of the loans being in trouble peaked in January 2025, and now they're at a little bit lower point. So they peaked in 25, maybe they hit a little bottom in March, and they ticked up slightly in April. This is all to say, like, I think that things are shakier. It used to be on a clear upward trajectory in terms of like what's getting delinquent, how's special servicing increasing, but now things are just in a wobbly. It could go up or down depending on what source you're looking at.
That delinquent number, it went down, but it's starting to tick back up again.
Yeah,
so.
yeah. And this the kind of downshift and uptick that has happened before, and I wonder if maybe there is a lagging or some kind of relationship between like this current economic uncertainty and the delinquencies and special servicing rates. We'll have to see, because I did wonder if the early optimism that we had like kind of early in the year that sunk down. That it seemed a little tantalizing, but if anything, things are just shaky.
Yep. Now we got another piece from Trepp, and you were saying that these were a little contradictory.
A little bit, because Trepp. So we saw the sinking down, or we saw that downshift as CredIQ reported it. But in Trepp here, if you look at the overall rate, it really does seem like slowly ticking up. Not as dramatically as CredIQ, but this is also limited to the special servicing rates in CMBS loans. So maybe CredIQ captures a little bit larger of a field. But really interesting, and it just shows that like things are getting complicated. The pressure is not off. That's what I would probably like the upshot of it all. I do want to issue an informal corrective about this graph. The colors that they have on the right, they have overall rate, lodging rate, office rate, and the all-time high special servicing rate. So they have colors here. Let's say purple for office rate. Now, if you go and scroll on to the graph, the purple is mixed use. The lodging is green on the right, and office is green on the left.
They need to match their icons with their chart colors.
100%
if you're going to put icons with the same labels.
I was so confused because it said that things were driven by lodging. I was like, well, that's green, and green's going down. No. Green is to the right, the icon. You have to look to the green line on the graph. I feel like I'm describing an instruction manual to a very difficult to complete Lego set here, but
we're keeping you all safe here.
Yeah.
We got you. We don't want anyone to confuse.
That's
confused.
True. Yeah.
That is funny, man.
Yeah.
And good to know. All right, so I think we have time for it. I know we're kind of skipping through at a good pace, but I want to talk about this Biz Now piece, because I know that, again, this was on the fence, whether it was going to be on the docket or not. But and we don't need to go into a lot of detail, but I think it's worth talking about, because it's something that we have mentioned in talks of, RealPage and algorithms and rent control and all of that, and then meeting with national politics. Yeah. What's your take?
So the point of this is that the bill that is the kind of omnibus bill that's currently being discussed in Congress has some provisions that would ban states from regulating artificial intelligence for the next decade. There's some protections for artificial intelligence, especially against regulation. And the argument here is that RealPage, which uses artificial intelligence in its rent setting algorithms, would be protected from bans against it. Recent bans that have been in place in certain places in the West, I think. And then there was also some bills that were being discussed last year. I remember going through some of them. There were some in California, maybe some in Washington, I believe. And I looked at the language. This is my take, is that RealPage loves calling it artificial intelligence. I think they like it. I think it is a great marketing tool. I still see it as an algorithm, but that's fine. It's a finer point that they can maybe.
I know.
What
Obviously, there's a difference, but like in the context of what we're talking about, the issues that people are having with it, like.
And I think that they would
using
also
a calculator to
appreciate being lumped in with that protection. That's nice for them. But some of and we talked about the language of these bills on the West Coast and in other places against like rent setting algorithms. Some of them are so broadly worded that if you use an abacus and called 3 landlords, you'd be in trouble with that. It doesn't need a artificial intelligence. It just needs, like, if you use computers and you talk to more than 2 other apartment buildings and determine their rent, then you fall within the technical, the intent or the spirit of the law, choose your one, but it's very broad. You could back a 1960s vacuum tube computer through the broadness of this bill.
So, I mean, do you see this if it gets passed, which is obviously it's not fully, it's working its way through.
It came through the committee,
Congress. Could this be a full relief for RealPage and basically to stop some of the lawfare, I guess, that's been applied to them, or but it's most of this has come from outside of the DOJ action. There's been a lot of local municipalities that are trying to push for the.
I think it is interesting because you're right, like some of the regulations were not necessarily, even on computers. It was like, can you share publicly or privately available information? It didn't deal with the number crunching. It dealt with like you're using your proprietary information and you're using it kind of like I don't know what the term is, but they have the
to collude.
Yeah, the kind of collusion. Yes, that's what it was. To establish rent in that way. I think though that it would be a benefit. I think it's a foothold it can help them in the courtroom. And they'll probably argue it, and they'll probably spend some more time. They'll be able to have their algorithms.
Well, because if the argument is, we can't regulate AI because it's going to, help in so many different ways that we can't even understand in so many different industries. It's hard to say, well, we can't apply that to this industry and that industry because. Yeah. I guess that I'm curious of what the reason would be, other than really making housing a protected industry that can't have any normal market pressures applied to it. Already is special because it's already a highly regulated industry to begin with.
I also thought that was interesting too, because at least if you can take the perspective of people that are against these algorithms that are giving them no choice and that are choosing for other people, I think that AI is a bigger boogeyman to me than like an algorithm or an equation or computer. It's this AI, you don't know what it's going to do next, versus like an algorithm. But that's a rhetorical point, maybe not a legal point. I just thought it was interesting.
And again, I think it's like, well, how is it being used? Like to what extent? And if the problem is price fixing or collusion and all the owners getting together, again, that never actually happened. Yeah. Or are we using tools for market analysis to see where pricing is and doing price discovery, and I don't know how that trying to figure out what you should charge for your product based on like the market.
Yes, that's what it is. That's all full stop. That's what it is, and it's like the programs that a gas station that a gas station would have to set theirs. I'm sure they have an algorithm of their own, and I'm sure like a farmer will have I don't know, maybe algorithms like some of the huge factory farms got to know where, they're probably not calling each individual other farm, but I don't know. I'll have to ask farmer friends to see how they set their prices.
Well, we'll have to ask Will too.
I know. Our video editor is a.
But I mean, if you think about when if you have all weather data information, past history,
throw that into
when how to plant.
Throw that into your calculator, not your computer.
yeah, get to say the way the DOJ.
Yeah.
But certainly plenty of industries are using AI and algorithms. The airlines are probably the most famous, but I mean even drive-through restaurants. I think Wendy's was thinking about adding like some like peak pricing.
Yeah.
And a lot of it isn't even necessarily to again maximize the price. It's more like to manage expiration schedules and to manage your rent roll and to make sure you're not like completely behind.
Not for nothing, rents went down. The time, and I think it was a timing things worked through the courts, or maybe, but like by the time things came to a head in terms of the legal actions that were being pursued against RealPage and other rent setting algorithms, they had the evidence of like the last 2 years rents have been stagnant. So what do you want?
Do you think someone will make a correlation? And I have to look at the exact dates, but like rent declines related to DOJ and other actions. It's like, sure, rents started declining as soon as the DOJ started going after RealPage, rents started to fall.
But at the very least, and this is
correlation causation.
Yeah. At the very least, this is just shows like it was supply all along. The program that the landlords are using has much less of an effect. You cannot erase the effect of a new apartment moving next door and moving rents down. RealPage can try as they might, but that's not going to happen.
Yeah, facts. All right, great episode of The Gray Report. Make sure you check out our latest episode where I interviewed Carl Whitaker, chief economist from RealPage. We had an incredible conversation, and that's a great reminder. You probably should be subscribed to the Gray Capital YouTube channel so you don't miss any of these great interviews. The weekly Gray Report, obviously, that Matt and I do, and you want to be signed up for the Gray Report newsletter, GrayCapitalLLC.com. It is the best multifamily newsletter on the planet. So GrayCapitalLLC.com. You can sign up. You will not miss a beat. Get all these reports and more sent to your inbox every Thursday morning with a quick recap on Sunday. All right. This has been a good week.
Oh, yeah. I'm ready for another one.
All right. Catch you in the next episode. Thank you.